Hey, what's up my friends? So welcome back to this training video where you'll learn all about the doji candlestick pattern, right? You'll learn what is the doji candlestick pattern, the three different types of doji candlestick pattern that you must be aware of, right? How to recognize it and how to find profitable trading opportunities, right? Using the doji candlestick pattern. So all this and more, continue watching. Okay, so what is a doji candlestick pattern, right? So to put it simply, right, a doji candlestick pattern is when the candle has the same open and closing price. So it looks something like this. You can see that the open and the close are the same level. So this is why you see a straight line on the chart. And then this is the high and the low. So one thing to take note is that a doji has no body on the candlestick pattern, right? But as you'll see later on, right, there are other variations of a doji pattern, right? And it's really not too important to concern yourself whether there is a small body or no body, no body, right? No body, right, on the candlestick pattern, right? So let's move on. So one thing to share first, right, is, don't make this mistake, right, when you're trading the doji candlestick pattern, right? Often what I see traders do is that, the market, right, moves up higher, and then there's a doji. Then they assume, right, that, hey, right now the buyers and sellers are in equilibrium, right? The trend has stalled. There's a good chance that it's going to reverse down lower, right? Well, not quite yet, because if you think about this, a doji simply represents, right, an indecision on this particular candle, a temporal indecision. So it's not going to be easy for just one doji candlestick pattern to reverse an entire trend, right? So don't make this mistake of, just going short just because you see a doji in an uptrend, because more often than not, right, the trend will continue. So be aware of this, okay? Moving on, right, let's look at the three different types of doji candlestick patterns and how you can trade them and find profitable trading setups, right? The first one is what we call the dragonfly doji, right? So again, right, the close and the open is the same level, but the difference this time around for a dragonfly doji is that the candle has a lower wick, right? A lower wick. So this means that you can see rejection of lower prices. So let me share with you how it looks like. So you can see that this is a dragonfly doji. This portion over here simply shows you rejection of lower prices. You can see that the market opened here, then it came all the way down, right? And finally, the buyer stepped in and pushed price back all the way up higher, and finally closing at the same price level. So this is, in essence, rejection of lower prices, right? It tells you that the buyers have, suddenly stepped in, right, and pushed price up higher. So based on the looks of this candlestick by in itself, right, this is a sign of strength because the buyers have, last minute pushed the price up higher. Okay, so how can you trade the dragonfly doji? Again, whenever you're trading candlestick patterns, right, I don't recommend that you trade it in isolation. Always do it in the context of the market. And I will share with you two types of market conditions that you can use to trade the dragonfly doji. First and foremost, right, you can trade a dragonfly doji, right, at support. Okay, so one thing to bear in mind is that recall, right, any candlestick pattern, okay, you have to understand, what is the meaning behind it, right? So the exact definition of a gravestone doji, dragonfly doji, right, is the open and close is at the same level, and then you have a long lower wick, right? But what happens if you have a small body, right, and the open is just slightly, let's say the open is just slightly below the closing price, or the open is just slightly above the closing price? Does it make much difference to the candlestick pattern? Well, not really, right? The context, the meaning of the candlestick pattern is still pretty much the same, right? If the open is like in this case, right, this candle over here, you can see that the open, right, it's slightly lower than the closing price. Does this mean that this pattern, you can't call it a dragonfly doji? Well, if you want to be exact, right, most traders would consider this a hammer, but it's somewhat a variation of the dragonfly doji, because the meaning of the candlestick pattern, understanding the meaning is what matters, not trying to memorize the exact candlestick pattern. Because if you try to do that, right, you're going to suffer in trading because there are hundreds and hundreds of patterns, right? So it's more important to understand the meaning of the candlestick patterns and understand the variations that could occur. I think that's much more important than anything else. Okay, so once you've understood this, right, here's an example of a variation of a dragonfly doji, right? It occurred at this area of support. Notice that the price came into this area of support, right? Rejection of lower prices, and the market closed slightly higher, which is a variation of the Dragonfly Doji, right? Next thing in the market, rallied higher back into this swing high and back into this area of resistance. So if you want to trade this pattern, you can look to get long. Stop loss, right? Put it below, right, this low of the doji. You don't want to put it smack directly below the low, because you could get stopped out quite easily. So give it some buffer, put it somewhere here. Okay, stop loss, you can put it somewhere here. And if you are a swing trader, you can look to take profits, right, at the nearest swing high or at resistance area. Okay, so this is one way you can look to trade this Dragonfly Doji, right, which is a variation otherwise known as a hammer. An alternate way to trade the Dragonfly Doji is when the market is in an uptrend, right? If you notice that the market is, let's say, above the 50 period moving average, for example, and it tends to bounce off it, repeatedly. When the market comes back to this moving average, right, this is an area of value, and this is where you could potentially, right, look for buy opportunity, right? In this case, right, you have well, to be exact, this is a hammer, but otherwise also known as it's a variation of the Dragonfly Doji. Is a hammer, right? You can see that the price comes into it, right, and then forms an entry trigger for you to go long. Again, your stop loss could put it a variation below this swing low somewhere here, right? And you can look to take profits, right, at the nearest swing high, or even look to ride this trend depending on your trade management, right? So what's really important over here, right, is to understand, right, yes, a Dragonfly Doji buy right, the open and close is at the same level, but you have to be open, right, to the possibilities in the market. Because I'll be honest with you, if you're a forex trader, it's unlikely you'll see Dragonfly Doji happening often, right? It doesn't happen often, because for it to happen, the open and the close has to be on the exact same level, right? Which is quite rare. So you have to be aware of the variations that could occur. This is so important. All right, so that's Dragonfly Doji for you. Moving on, right? The next Doji candlestick pattern that I want to talk about is the Gravestone Doji. All right, the candle has the, again, right, same open and same close, but this time around it has a long upper wick. So this means, right, that there is rejection of higher prices. The market has rejected higher prices, and it looks something like this. All right, you can see that open and close is at the same level, and then when the market just opened, the buyers were in control. Okay, and then suddenly the sellers took control and pushed price down all the way down lower, and finally closing at the open. Bear in mind, right, the Gravestone Doji, again, there could have been variations of it, like for example like this, right? You can see that the market, right, this could be let's say this is a bearish close, and look something like this, right? So this again could be another variation of the Gravestone Doji, right? The meaning is pretty much the same, right? This time around you have a small body, but again it still shows you rejection of higher prices. That is the key thing down here, and you have to anticipate that there are variations that could occur, especially in the FX markets. So how can you trade the Gravestone Doji, right? So again, right, so since this is a rejection of higher prices, you want to look for confluence, right, at levels where selling pressure could exist. And for example, over here, this is an area of resistance, right? And over here, you have a variation of the Gravestone Doji. Okay, you can see that the market rejected this higher prices and finally closing near the lows. So you can go short on the next candle, stop loss again above this highs, right, somewhere here, and look to take profit, right? For example, if you want to take a swing in this trade, you can look to take profit just before this area of support. So otherwise, just capturing one swing in the market. All right, that's possible. Another way you can trade the Gravestone Doji, right, is in a trending market. Right, so for example, if the market is in a downtrend, you can look for it to pull back to a moving average, pull back to previous support and resistance, or whatever, right? Whichever you define as an area of value. So in this case, right, this area of value is back towards this swing high, right, and in towards this 50 period moving average. Then again, you have a variation of the Gravestone Doji, otherwise known as a shooting star. It's another variation, right? Can go short on next candle, again stop loss, right, above this swing high, and depending whether you want to take a swing by exiting just below this swing low, or you can even trail the move, right, by trailing using a moving average structure of the markets, or whatever, whichever preference that you want to trail the stop loss, right? So you can see that the Gravestone Doji serves as an entry trigger, right? And after which, depending on your goals on the trade, right, whether you want to capture a swing, whether you want to capture a trend, right, you can use the appropriate trade management or trailing stop loss technique. Okay, so at this point in time, right, we have covered the Gravestone Doji and the Dragonfly Doji. The third one I want to talk about is the long-legged Doji, right? So basically, it looks like a normal standard Doji, right? Open, close, same level, but this time round, the upper and lower wick is very long, right? They are very long. So this means that there is strong indecisions in the market, and it looks something like this. It's like a regular Doji, but this time round, right, the highs and lows of the candle is is very long, okay? So this means that there is strong indecision in the market. So how do you trade the long-legged doji? Okay, so I just want to share with you how it looks like first. You can see that on this time frame, this is the weekly time frame, it forms a long-legged doji here on the weekly time frame. Usually it's due to news release, the market reacts to it, spike up and down, right? That's why you have a long-legged doji on your chart. Okay, when you see this chart pattern, it can be difficult to just trade off it directly because the range of the candle is so wide, and if you want to trade off it, right, your stop loss is going to be very wide as well. So usually if you see a long-legged doji, I will not trade it on that time frame itself, right? What I'll do instead is this, is that you go down to a lower time frame, right? Like this is the daily time frame. Earlier you saw is the weekly time frame. This is now the daily time frame, and then you can actually use the highs and lows of the long-legged doji as a frame of reference, as a frame of area of value where you can look to either buy or sell. So in this case, right, you notice that the highs and the lows of the long-legged doji actually, right, became, right, support. I mean, this is resistance and support, right, on the lower time frame. So now you have support and resistance that you can trade off, right? And you can use these levels, these areas on your chart to establish, right, a bias, to establish positions to enter a trade. So in this case, right, the market came up higher into this area of resistance, which is simply the highs of the long-legged doji. It formed, right, this bearish engulfing pattern, right, showing rejection of lower prices. Again, you can go short on the next candle's open, stop loss either above this high or above this high over here, right, and then look to ride the move down lower. So this is how you can go about trading the long-legged doji. And another way to do it, right, is another extra tip, right, is that you know that this is pretty much a range, right, on the lower time frame. So what you can do is that, if the market repeatedly tests the highs, for example, it repeatedly tests the highs of this long-legged doji, tested highs, test the highs, test the highs. This will tells you that, hey, the market is willing to buy at this higher prices, and there's a good chance that this market could break out higher, and you can look to trade the break out of the highs. Okay, but generally, usually the first retest, right, especially if the move comes in very nice and strong, right, the level usually would hold and in reverse lower. But if the market comes back to the level repeatedly over a short period of time, there's a good chance that it could break out, and you want to be trading the breakout of the highs. Okay, so let's do a quick recap to what you've learned today, right? Number one, a doji is simply a candle, right, with the same open and close. A dragonfly doji is a sign of strength because it shows you rejection of lower prices. A variation of this candlestick pattern is the hammer, right? You can look to buy it at support or in an uptrend near a moving average or near, previous resistance turn support. A gravestone doji, right? It's a sign of weakness because it shows you rejection of lower prices. You can look to sell it at resistance or, at moving average and etc. And the long-legged doji usually is a very huge candle that you see on your chart, right? So usually I don't trade off that time frame itself. You go down one time frame lower, you can better define the highs and lows, which are support and resistance. And from then on, right, you can actually look, right, to find trading opportunities, right, based on the long-legged doji that form on the higher time frame. Okay, now if you've enjoyed this video and you want to learn more, practical trading strategies and techniques that work, you can go down to my website, right, over here, tradingwithrainer.com. Right, tradingwithrainer.com, right, and just scroll down a little bit. You see these two trading guides. One is the ultimate trend following guide, and the other one is the ultimate guide to price action trading. Right, so if you want to learn more about price action trading, how to better time your entries and exits, right, download this guide you see over here. Just click this blue button, right, and I'll send it to your email address. However, if you want to learn how to write massive trends in the market, right, then download the ultimate trend following guide, right, and again, right, I'll send it to your email address completely free of charge. All right. So that's pretty much it, right? If you've enjoyed this video, right, and you want to, learn, if you have any questions for me, leave it in the comment section below, right? I'll respond to you. And if you enjoyed this video, hit the thumbs up button, right, and subscribe to my channel for more videos to come, right? So with that said, I wish you good luck and good trading. I'll talk to you soon.